Hello and welcome everybody to another episode of Books and Bytes. Today we're diving deep, into John H. Cochrane's The Fiscal Theory of the Price Level, a book that really kind of shakes up how we think about money and inflation.
Yeah, it's a fascinating read. It challenges a lot of the conventional wisdom, that we've come to accept about economics.
So for our listeners who haven't had a chance to crack open this book yet, can you give us a quick rundown of the core ideas? What are the big takeaways?
Absolutely. Cochrane's main argument is that the value of money is fundamentally tied to the government's fiscal health. Its ability to manage its spending, taxation, and debt. It's not just about how much money the central bank prints, but about the market's confidence in the government's long-term ability to meet its financial obligations. He calls this the fiscal theory of the price level.
Okay, that's a pretty bold statement.
Yeah.
So he's saying that inflation isn't just a monetary phenomenon, it's deeply rooted in fiscal policy.
Precisely. He argues that traditional monetary theories, which focus mainly on the money supply, they fail to explain how prices are actually determined in modern economies. He points out that today, central banks mainly operate by setting interest rate targets, not by directly controlling how much money is out there.
And he's saying that this shift in how central banks operate requires a new way of thinking about inflation.
Exactly. And that's where the fiscal theory comes in. It provides a framework for understanding how fiscal policy, things like government spending, taxation, and debt management, they directly influence the value of money and the level of prices.
All right, I'm ready to unpack this. Let's dive into the book. Where does Cochrane begin?
He starts by laying out the foundation of his theory with the government debt valuation equation. This equation, which he describes as the bedrock of the fiscal theory, it states that the real value of government debt must equal the present value of all future primary surpluses.
Okay, that sounds a bit technical. Can you break that down for us? What does that actually mean?
Sure. In simpler terms, it means that the price level adjusts so that what the government owes in outstanding debt is balanced by what it's expected to earn in the future through surpluses. That is when it takes in more tax revenue than it spends.
So the value of money is essentially tied to the market's belief in the government's ability to pay back its debts through future surpluses.
Exactly. It's all about expectations and confidence. If the market believes the government is on a sustainable fiscal path, then the value of money remains stable. But if doubts arise about the government's ability to manage its finances, that can erode the value of the currency and lead to inflation.
That makes sense. But what about those countries that run persistent deficits, like the U.S.? Doesn't that contradict the whole idea?
It's a common question, and Cochrane addresses it directly. He argues that even with deficits, the theory holds true. It's not just about the immediate deficit, but about the long-term trajectory of government finances. He uses a concept he calls S-shaped moving averages to illustrate this.
S-shaped moving averages. Can you explain that a bit further?
Sure, it's a way of looking at the bigger picture of government finances over time. Cochrane argues that short-term deficits aren't necessarily a problem as long as they're eventually offset by future surpluses. It's like a company taking out a loan to invest in a project that will generate future profits. The initial debt is manageable as long as those future profits materialize.
So it's not just about balancing the budget year to year, but about ensuring that the overall trajectory of government finances is sustainable in the long run.
Exactly. And this brings us to another key point that Cochrane emphasizes: the importance of discount rates when valuing government debt.
Okay, discount rates. Those reflect the time value of money, right?
Right.
A dollar today is worth more than a dollar tomorrow.
Yes, precisely. Because future surpluses are further out in time, we have to discount them to understand their value in today's terms. This is where Cochrane introduces a crucial identity. The log value of debt to GDP equals the present value of future surplus to GDP ratios, plus GDP growth, all discounted at the real return on government debt.
All right, let's break down that equation. What are the key takeaways here?
Well, this equation highlights how economic growth and the return on government debt play a significant role in determining the value of that debt. For example, if economic growth is robust and the return on government debt is relatively low, then the present value of future surpluses is higher, making the debt more sustainable. But if growth is sluggish or the perceived risk of holding government debt increases, that pushes the value down.
So a change in market sentiment, perhaps driven by concerns about future economic growth or the government's ability to repay its debts, can have a real impact on the value of money today.
Absolutely. It's a dynamic interplay between expectations, perceptions of risk, and the fundamentals of government finances. And this is where Cochrane's theory gets really interesting because it challenges some of the traditional ways we think about monetary policy.
Okay, how so? How does this fiscal theory change our understanding of how things like interest rates impact the economy?
Well, one of the most intriguing aspects of Cochrane's theory is how it incorporates the concept of sticky prices, the idea that prices don't always adjust instantly to changes in supply and demand.
Because in the real world, it takes time for businesses to change their prices and for consumers to adjust their spending habits, right?
Exactly. And this has important implications for how interest rate changes actually play out in the economy. What he's saying is that even in a world with sticky prices, fiscal policy remains the ultimate driver of inflation.
So even if the central bank raises interest rates to try to cool down the economy, if the government isn't doing its part to manage its spending and debt, those efforts might be ineffective.
That's a key takeaway from Cochrane's work. He argues that monetary policy in the form of interest rate adjustments, it can't truly stabilize the economy on its own. It has to work in tandem with responsible fiscal policy. In fact, he argues that in some cases, raising interest rates could actually lead to higher inflation, contrary to conventional wisdom.
Wow, that's a pretty counterintuitive idea. How is that possible?
It all comes back to the interplay between monetary and fiscal policy. If the government doesn't adjust its spending and taxing decisions in response to a change in interest rates, the impact on inflation can be different than what traditional models predict. For example, if the central bank raises rates but the government continues to run large deficits, that could actually fuel further inflation.
So he's suggesting that we need to rethink the traditional view that central banks have sole responsibility for managing inflation.
Yes. He argues that we can't understand inflation without considering the combined impact of both monetary and fiscal policy. They're intertwined, not separate levers that can be pulled independently.
That makes a lot of sense. It highlights the importance of coordination between the central bank and the government when it comes to managing the economy. But it also seems like a pretty radical departure from traditional economic thinking. Does Cochrane address any of the criticisms that have been leveled against the fiscal theory?
He does. He dedicates a whole chapter to tackling some of the most common criticisms head on. One of those is that the fiscal theory is hard to test empirically because it's difficult to isolate the effects of fiscal policy from all the other factors influencing the economy.
Right, because so many things can impact inflation, from global supply chain disruptions to changes in consumer demand.
Exactly. And Cochrane acknowledges that this is a valid concern. But he argues that we need to look beyond simple correlations in the data and pay closer attention to the underlying regimes that govern monetary and fiscal policy.
Regimes, what does he mean by that?
He's referring to the rules, institutions, and expectations that shape how governments manage their finances and how central banks operate. These regimes, he argues, can profoundly influence how the economy responds to different shocks. He urges us to consider the historical context, institutional frameworks, and even the statements of policymakers when trying to understand the drivers of inflation.
So it's about understanding the bigger picture, the rules of the game, the intentions of policymakers, not just looking at the numbers in isolation.
Precisely. He's advocating for a more nuanced approach to economic analysis that considers both the quantitative data and the qualitative factors that shape economic outcomes.
This has been a great overview of the foundation of Cochrane's fiscal theory. It's challenging some of my deeply held beliefs about how the economy works. Where does he go from here?
Well, now that we've laid the groundwork, we can explore some of the most fascinating implications of his theory. How it explains hyperinflation, what it means for the future of cryptocurrencies, and how it challenges long-held economic doctrines.
Those are some big topics. I'm definitely eager to dive into those.
Welcome back to our deep dive into the fiscal theory of the price level.
Last time, we got a great overview of the core principles of Cochrane's theory. We talked about the government debt valuation equation and how the market's confidence in the government's ability to generate future surpluses plays a key role in determining the value of money.
We also touched on the importance of discount rates and how Cochrane challenges the traditional view of monetary policy, arguing that fiscal policy is the ultimate driver of inflation even in a world with sticky prices.
Right. He's really making the case that we need to rethink our understanding of how inflation works and how it's managed. Now, I'm curious to see how he applies these ideas to real-world situations. Does he look at any specific historical examples?
He does. In fact, he examines one of the most extreme economic scenarios imaginable, hyperinflation. He argues that these periods of runaway inflation, which have devastated economies throughout history, they're a prime example of how the fiscal theory plays out in practice.
Okay, so how does he explain hyperinflation through this lens?
He argues that hyperinflations happen when the market completely loses confidence in the government's ability to repay its debts through future surpluses. This loss of confidence leads to a collapse in the value of government bonds and a corresponding surge in the price level.
So it becomes a self-fulfilling prophecy. As inflation spirals out of control, people become even more skeptical of the government's ability to restore order, further eroding confidence in the currency.
Exactly. And what Cochrane emphasizes is that ending a hyperinflation requires more than just the central bank trying to control the money supply. It requires a fundamental shift in fiscal policy to convince the market that the government is serious about getting its finances in order and restoring long-term debt sustainability.
So it's about restoring trust in the system. People need to believe that the government will eventually bring its spending under control and start generating the surpluses needed to back the currency.
Precisely. And he points to historical examples like the end of hyperinflation in Austria in the 1920s, where fiscal reforms played a crucial role in stabilizing the currency. He argues that these reforms signaled a credible commitment to fiscal responsibility, which helped restore confidence and ultimately bring inflation back under control.
That's a really compelling point. It highlights how monetary policy alone can't solve deep-rooted fiscal problems. It's like trying to put a Band-Aid on a broken leg. But his book isn't just about analyzing the past, right? He also looks at how these ideas apply to the financial innovations happening today, like cryptocurrencies.
You're right. Cochrane delves into the world of cryptocurrencies and explores how they might fit into this fiscal framework. It's a hot topic and one that a lot of our listeners are probably wondering about.
Absolutely. Cryptocurrencies are often seen as being outside the control of governments. They operate on their own decentralized networks, with their own rules and protocols. So how does he reconcile that with the fiscal theory?
He acknowledges that cryptocurrencies operate differently than traditional government-issued currencies, but he argues that even these digital assets can't entirely escape the influence of government fiscal policy.
Okay, I'm intrigued. How so?
Well, he points out that the value of any currency, whether it's dollars, euros, or Bitcoin, ultimately depends on its usefulness in facilitating transactions. If people don't believe they can use a currency to buy and sell goods and services, then it won't hold any value.
Right. It needs to be accepted as a medium of exchange. But cryptocurrencies are already being used for transactions. We're seeing more and more businesses accepting them as payment.
That's true. But here's the key point that Cochrane makes. Governments still play a massive role in determining what's accepted as payment for taxes, and that gives them significant leverage over the value of any currency, even cryptocurrencies.
Because if the government only accepts dollars for tax payments, that creates a strong incentive for people to hold dollars, even if they also dabble in other currencies.
Exactly. That demand for dollars, driven by their use in paying taxes, gives the government a powerful influence over the dollar's value, even in a world with competing currencies. And this is where things get really interesting when we consider cryptocurrencies.
So you're saying that even if cryptocurrencies become more widely accepted for everyday transactions, their value could still be impacted by government policies, particularly tax policies.
That's one of the implications of Cochrane's analysis. He doesn't offer any definitive answers about the future of cryptocurrencies, but he encourages us to think deeply about how these digital assets might be integrated into existing fiscal and monetary systems. He even raises the possibility of governments issuing their own digital currencies, which would further blur the lines between traditional currencies and cryptocurrencies.
That's fascinating. It really highlights how these new technologies are forcing us to rethink some of the fundamental concepts of economics.
It is. And Cochrane doesn't shy away from challenging other long-held economic doctrines. For example, he takes aim at the Taylor principle, which has been a central tenet of monetary policy for decades.
Remind us again, what's the Taylor principle?
It's the idea that central banks need to raise interest rates more than 1-for-1 in response to rising inflation in order to effectively stabilize the economy. It's become a sort of rule of thumb for how central banks should respond to inflation.
But Cochrane challenges this, right?
He does. He argues that the Taylor principle is based on the assumption that fiscal policy is passive, meaning that governments will adjust their spending and taxing in line with the central bank's actions.
But the fiscal theory flips that assumption on its head, doesn't it?
Exactly. The fiscal theory assumes that fiscal policy is the dominant force. And if that's the case, then the Taylor principle may not be the best guide for setting interest rates. In fact, he argues that in some cases, adhering to the Taylor principle could actually destabilize the economy.
Okay, so he's suggesting that we need a new playbook for monetary policy, one that takes into account the dominant role of fiscal policy.
That's a key takeaway from his work. He's arguing that we need a more coordinated approach, where monetary and fiscal policy work together to achieve economic stability. And this leads him to another controversial topic, the concept of observational equivalence.
Observational equivalence. What's that all about?
It's the idea that different monetary and fiscal regimes can sometimes produce similar outcomes, making it difficult to determine which policy is actually driving those outcomes.
So it's hard to tell whether it's the central bank's actions or the government's fiscal policies that are really responsible for, say, a period of low inflation or high economic growth.
Exactly. And Cochrane acknowledges that this presents a challenge for economists trying to test the fiscal theory empirically.
So how does he address that challenge? How do we disentangle the effects of fiscal policy from all the other factors that can influence the economy?
He argues that we need to move beyond simply looking at correlations in the data. We need to delve deeper and consider the underlying regimes at play. The rules, institutions, and expectations that shape how monetary and fiscal policy are actually implemented.
So it's not just about looking at the numbers, but about understanding the context in which those numbers are generated.
Exactly. He emphasizes the importance of considering historical context, institutional frameworks, and even the public statements of policymakers when trying to understand the drivers of inflation.
So it's about looking at the big picture, not just focusing on isolated data points. It seems like he's advocating for a more holistic approach to economic analysis.
He is, and this leads him to another interesting point, the liquidity of government bonds.
Okay, liquidity. That refers to how easily something can be bought or sold, right? How liquid are government bonds and why does it matter?
Government bonds are generally considered to be quite liquid, meaning they can be bought and sold relatively easily in financial markets. And in traditional monetary theory, there's this idea that if government bonds were too easy to trade, they would become indistinguishable from money itself.
And that could lead to problems, right? Like runaway inflation.
That's the traditional thinking. The idea is that you need to maintain some separation between bonds and money to keep inflation in check.
But Cochrane challenges that view, doesn't he?
He does. He argues that from the perspective of the fiscal theory, the liquidity of government bonds doesn't actually affect how the price level is determined. He points out that bonds and money are already closely linked in modern economies.
So the ease with which a bond can be traded shouldn't affect its fundamental value, which, according to fiscal theory, is tied to the government's ability to repay its debts through future surpluses.
Exactly. And this leads him to suggest that making government bonds even more liquid could actually be beneficial.
Okay, that's counterintuitive. How could making bonds more liquid be a good thing?
He argues that it could lower the government's borrowing costs and improve the efficiency of financial markets. This could potentially free up resources for other productive uses, which could benefit the economy as a whole.
So he's turning the traditional view on its head and arguing that the supposed dangers of highly liquid government bonds might be overblown.
That's one way to put it. And this exploration of bond liquidity leads him to a broader discussion of alternative monetary arrangements, systems that go beyond the familiar model of government-issued fiat currencies.
This is where things get really interesting. Earlier, we talked about how Cochrane draws parallels between government debt and gold-backed currencies.
Exactly. He revisits this idea and explores how a system where the basic unit of account, the numeraire, is defined by something other than government-issued money might function.
So instead of relying on the government's promise to generate future surpluses, could you back a currency with something tangible, like a basket of commodities? Or maybe even a digital asset like Bitcoin?
He explores those possibilities. He dives into the mechanics of how such systems could determine the price level and maintain stability. He considers the challenges and potential benefits of these alternative arrangements.
It's really pushing the boundaries of conventional monetary thinking. It's making me question a lot of what I thought I knew about how money works.
It's a thought-provoking journey, for sure. And throughout this exploration of alternative monetary systems, Cochrane consistently brings it back to the core principles of the fiscal theory, demonstrating how the government's fiscal commitments, or lack thereof, ultimately underpin the value of any currency regardless of its form.
It's a powerful reminder that even as technology rapidly changes the financial landscape, the fundamental principles of economics still apply.
Absolutely. And in the final part of our deep dive, we'll explore Cochrane's conclusions about the implications of the fiscal theory and what it might mean for the future of our economies.
I'm really looking forward to unpacking those. This has already been such an eye-opening discussion. Welcome back to the final part of our deep dive into the fiscal theory of the price level.
Yeah, it's been quite a journey, exploring John Cochrane's ideas and how they challenge so much of what we thought we knew about money inflation and economic policy.
We've covered a lot of ground, from the fundamental equation that underpins his theory to its implications for hyperinflation and even the future of cryptocurrencies.
Right, and we've seen how he argues that fiscal policy, government spending, taxation, and debt is the true driver of inflation.
And how it's not just about controlling the money supply, it's about the market's belief in the government's ability to manage its finances responsibly and sustainably over the long term.
Right, and now as we wrap up this deep dive, I'm eager to hear what Cochrane himself sees as the biggest takeaways from his work. What does he want us to remember?
Well, he certainly doesn't hold back. He states quite plainly that he believes the fiscal theory is the only theory that can truly explain how the price level is determined in modern economies.
Wow, that's a bold claim. Is he essentially saying that all those traditional monetary theories are obsolete?
He doesn't mince words. He argues that those theories which focus mainly on the money supply just don't hold up when you consider how money actually works in the real world today.
He's pointed out repeatedly that central banks no longer operate by directly controlling the amount of money in circulation. They primarily work by setting interest rate targets.
And he argues that this shift demands a new framework for understanding inflation, one that recognizes the dominant role of fiscal policy.
Right, and he also highlights how the line between money and government debt has become increasingly blurred, particularly with the rise of electronic payment systems and digital currencies.
So it seems he's making the case that we need a more comprehensive and realistic theory, one that takes into account these modern complexities.
Exactly, and he believes the fiscal theory is that theory. He even offers evidence to support his claim. He points to the failure of traditional monetary theories to explain events like the period of low inflation that followed the 2008 financial crisis.
That was a time when interest rates were stuck at zero for an extended period, and conventional wisdom said that would inevitably lead to deflation. But it didn't happen.
Right, and Cochrane argues that the fiscal theory can explain why. Because even though central banks were pumping money into the economy, the market didn't panic. It continued to believe that governments would eventually take steps to restore fiscal balance.
So the expectation of future fiscal responsibility helped to anchor inflation expectations, even in the face of extraordinary monetary stimulus.
Precisely. And he uses this example to underscore his central point. Sustainable price stability depends on sound fiscal management, not just clever monetary policy tricks.
He's essentially saying that if the government's fiscal house is in order, then the central bank has a much easier job.
Makes sense to me.
But it also implies that we need to shift our focus when it comes to managing the economy. We need to pay much more attention to long-term fiscal sustainability.
Right. He's talking about things like controlling government debt, ensuring that spending doesn't spiral out of control, and making sure that tax revenues can keep pace with government obligations.
It's about making tough choices today to avoid potentially catastrophic consequences down the road.
He doesn't just offer warnings, though. He actually lays out some concrete steps that governments can take to improve their fiscal health.
What are some of his recommendations?
Well, he's a big advocate for transparent and credible fiscal rules, clear guidelines that outline how the government will manage its budget, both when times are good and when they're bad.
So it's about being upfront with the public, about how the government will respond to different economic circumstances, building trust and predictability.
Exactly. He also suggests that these rules should be designed to ensure that government debt remains sustainable over the long haul, that it doesn't grow faster than the economy's ability to support it.
That makes sense. It's not just about reducing debt today. It's about putting in place mechanisms that will prevent it from becoming a problem in the future.
Right. And he also stresses the importance of policies that promote long-term economic growth, because a dynamic and expanding economy can generate the tax revenue needed to service the debt and fund essential government programs.
So it's not just about austerity. It's about fostering innovation, encouraging investment, and boosting productivity.
He sees sound fiscal management as being about creating the conditions for a thriving economy, not just balancing the books.
It's a holistic view that connects fiscal responsibility with economic prosperity. But he also acknowledges that this shift to a more fiscally centered approach won't be easy.
Right. It's a big departure from how many governments operate today, and it would require significant changes in priorities and practices.
It might even challenge some deeply entrenched political interests.
Absolutely, but he argues that it's a necessary change if we want to avoid repeating the economic calamities that have marked history.
He's issuing a call to action, urging us to rethink our economic priorities and to focus on building a more stable and resilient future.
It's a powerful message and one that resonates deeply in our current economic climate.
This deep dive into the fiscal theory of the price level has been a real eye-opener. It's given us a new lens through which to view some of the most pressing economic issues of our time.
It's challenged our assumptions, expanded our understanding of how money really works, and left us with a lot to ponder.
Until next time, keep those brains buzzing.